Who doesn't love bonds these days, guys? It seems like everyone loved bonds going into last week before that 5% pullback in TLT. I don't think anyone should be surprised that we saw a market come back in. The CME Fed Watch tool, which is fantastic, one of our sponsors on Futures Power Hour, of course, they point out that the implied probability of a Fed rate cut at its peak last week was 72%. 72% for the Fed to cut rates within 1 week of last Monday. That obviously was overcooked. There were 6 cuts priced into the end of the year at one point last Monday. And we've seen already in 2024, when we reached that crest, which we were at the start of this year, the market just thinks it's too fast, too soon. But the good news is for long bond traders, the pullback that we just saw may have been the pullback, not just because of today's action after the PPI data, but coming into today, the market has officially wiped away those excess Fed odds. We're now looking at a base case scenario of 3 rate cuts in 2024 with the optionality for a 4th. But that has removed the albatross around the bond market's neck. And something that I think is a really important observation that's changed over the past month is that bonds and stocks are now trading somewhat conversely. On days when stocks are down, bonds are not being pointed at as the reason for why stocks are down, the fear of higher yields. No, they're actually operating in that traditional 60-40 portfolio sense. And so the long bond market right now, it's a trade that I think if you continue to just have it in your pocket with time on your side, long duration, it's worth keeping around as equity markets continue to experience this nice two-way volatility.
Okay, nice little talk there, but what's your point?
I'm saying right now, people have been talking about equities for the past week for right reason, because you had IVRs north of 100, but the structure and the fundamental tailwind of this bond market right now means it shouldn't be overlooked, particularly because if you've had exposure to bonds over the past 2 weeks, it kind of served as an all-weather vehicle protecting you from that downside in the broader equity market. It's no longer a position that's correlated with what stocks are doing. It's actually trading as an inverse vehicle. It's a good hedge now, in effect.
I mean,
it brings diversification to your portfolio.
For the time being, sure. No question about it. But I don't think that people trade that way anymore or think that way. I don't think you can count on that inverse correlation. And so I don't think it really means anything. It's just a nice observation because I don't think you can count on it. Just like I don't think you can count on any of the kind of risk off. Like if you're going to diversify, it doesn't matter what you diversify into because you have no idea what those correlations are going to look like after something ugly happens until after it happens. And that's all it is. The bonds, yeah, they've had a nice inverse relationship with stocks lately, but I don't think you can count on that. That's not a trade. You know what I'm saying? I don't think it's a trade.
Well, I wanted to use it as a springboard to talk about what didn't behave well last week as somewhat as a hedge against stocks, and that was crypto. I'm curious, actually, Tom, on your take about crypto's role in all of this, because we've heard so many machinations, stories, theories that crypto is an alternative to gold. It's a safe haven during times of geopolitical stress. When last week during the sell-off, it just more or less acted like a high beta NASDAQ. Is this a knock against crypto moving forward, that even during these times of tumult, when it's supposed to be advertised as a place where people can flee to, it experiences more volatility than even the Japanese stock market?
Hold on. I got to give you a little pushback here. We've never looked at crypto. We've tried to find a correlation or an inverse correlation to it and everything else. It's pretty random. And yes, it's had a big move from $70,000 to $50,000. It's sitting at $60,000, but it's been going sideways for the last 6 months.
I mean, was the move in crypto any greater than the move in NVIDIA on a percentage basis? Was it any greater than the move in AMD? I don't think so. Like, I think you're talking about almost, high teens to high 20s% on a percentage basis. And I'm not sure it was any greater. And given the fact that it has a little bit higher volatility than some of those other stocks, I think it was right in line with what you would expect for that kind of volatility expansion. And let's be fair, I also think that they sold every asset. Like, it wasn't just crypto. I mean, it was, every single asset got sold down. Basically, every commodity on my board was on its lows. I think it's a fair topic to talk about. I don't really think the crypto positions are big enough to have any kind of an impact. For most traditional investors, their crypto position is minuscule. If it's a fraction of a percent, that's a lot. I think in a traditional sense, it's tiny. I think if you're thinking about crypto investors, most of those are highly concentrated. Like, I think about like my son, for example, his investments are highly concentrated in crypto. He's a typical, 30-year-old. For somebody like that, it makes sense to me. But for most investors, especially older investors, I don't see it at all. I think their positions are tiny.
I think one of the bona fides of what we've seen from the ETF market in recent weeks and months is that even during last week's pullback in crypto, there was still significant inflows into the space overall. People are not exactly jettisoning it. And people who are using the ETFs are probably buy and hold investors. Not many people are trading in and out of those vehicles on a day-to-day basis. But I think the broader point that I'm trying to get at is when you look at what those correlation one type events, if we're heading into an environment where people are fearful that volatility is going to stay up, diversification doesn't mean just being long a bunch of different things. It means being long the things that typically go up when everything else is going down. And crypto last week didn't hold up to the degree that a lot of its enthusiasts would purport it would, saying it's digital gold. Gold did hold up last week. Silver was worse for the wear, of course, but gold held up. The dollar held up. The yen held up, as Ilya would dutifully point out, but not crypto. And so crypto is behaving very much like a levered beta asset right now. And traders should be mindful of that if they're looking at the NASDAQ. If they think the NASDAQ is going to go down, they need to reconcile that with the price action that we've seen in these emergency type of situations when crypto gets its feet put to the fire as well. But Tom, you don't seem to want to talk about this either, because I have a whole bond spiel here for today in the Fed. So what do you want to talk about today?
The reason I don't want to talk about the Fed is because I think it's the same story. I don't think anything's changed, like from last week to this week, just based on where bonds right now. They're almost 124. That takes a lot of pressure off the Fed. Like I think a week ago, we were having this conversation. We were closer to 122 or maybe a couple of days ago, closer to 122. And that puts a little more pressure on the Fed. I think at 124 in the long bond, it takes all the pressure off them. They can really do whatever they want. I think it's basically a riskless for them. But I think the more interesting discussion, the direction of the one thing that could have helped last week was that you were in lots of different products. I don't think it matters that it's bonds and stocks. I think it just matters that it's a bunch of different stuff. The stuff that I got hurt on last week was just short premium and vol expansion. What I didn't get hurt on was the down move itself because I was really well diversified. I think that people that were in highly concentrated positions, whatever those positions were, if they were all Bitcoin or all S&Ps or all, tech stocks or all something else, that was the hardest thing to deal with because you can rationalize a pop in volatility. And so you can explain the P&L drawdown because it's simple. Options go, if you're short a strangle, it's $5, it goes to $10 or $13. That's your loss. What you can't rationalize is having either too big a position or too concentrated position. So I think the biggest takeaway from last week is not that you needed to have bonds and stocks and that relationship is now inverse after not being inverse for 10 years. I think the biggest takeaway is in down moves, you really have to focus on, there's two things that you always have to be prepared for in the market. One is that your positions aren't correlated, and two is that your position size is small enough. And I think that's the lesson learned from last week. That's the biggest takeaway for me.
Yeah, and certainly I think if you were looking at this market on a short-term basis, right, it was very difficult to time whether or not this was something going to stick around off the lows. But the longer-term view, right, if you look on Monday and said, okay, volatility is 60 in the VIX, 35 in the VIX, wherever you looked at it during the day, how long is this going to last? How long historically does this last? You know what? I can go out, I can give myself, forget 30 days, I can go out 60 days, and I can look to sell this pop in volatility. Now a week later, we're well off the lows, 200 plus points in the S&P 500, it looks like still. The NASDAQ is continuing to make further headway. We're not out of the woods yet, technically, though. I want to point that out here. It's one of the reasons why I've been reticent to really go full bore back on the bull side. Seasonality aside, which this is really the crappy part of the year, folks, for stock markets, at least it has been historically. We're still in a downtrend from the July and August swing highs in the NASDAQ. Same goes for the S&P 500. And even in that bounce that we saw at the end of July, we ran into the 1 month moving average in both indexes and immediately failed. Like the first day of the test, hit it, failed. So here we are on approach to it again. Everything's looking good. If the NASDAQ gets there, it's back in the uptrend from the October and July lows, but we haven't actually crossed that bridge yet. And CPI is tomorrow, of course. So this could be a little bit of a fake out for me. There's a lot of wood to chop still. And, this rally here seems very, very tentative as far as I'm concerned. Victor likes to point out that when you're in this 18 to 22 zone in the VIX, it's kind of like the witching hour. You don't really know if you're going to stop going up here or this is the threshold that leads to a gigantic or much more significant explosion in volatility. And it feels like we have good reasons to stay in this zone, at least for the next few weeks, for the foreseeable future. So if I'm going to be long equities here, it's got to be really light, and I've got to be really decisive in willingness to cut positions if they turn against me, because this market has proved very fickle.
We've definitely had good two-sided action. I mean, we're up to 5,600, below 5,200. We're sitting at 5,400. I mean, we're basically halfway back from our
it's a nothing sell-off. I mean, in hindsight, it was just violent. It's crazy violent. I think another huge takeaway for me from last week was that we've never seen a volatility explosion like that on a move that's so small. So the biggest takeaway, I think, is just, are we entering a little bit of is there a new world out there now where you could have a 3% move?
Yeah, it was only a 3% move. I mean, we had a
3% move and volatility doubles?
Yeah.
Goes up 50%?
Yeah.
A 3% move? There was something that happened last week that was... Well,
from market highs, too.
I know, from market highs.
So, if we fell 3% from here, I don't think volatility is going to move nearly as much as it did that.
I don't even know if it goes up. Right. I think what we learned from that is that when volatility is low and it's been depressed for so long, that you could have moves like that. And that's another huge takeaway from last week. One was the stay small, diversify, and the other one was, wow, volatility can really move. And it can be incredibly, I mean, a 50% move on a 3% move in the market. What if we had moved 8%? Wasn't Japan down like 11 or 12% one day?
12.
I mean, what would volatility have done if we were down 12%? Would it have been 80?
I don't know. Yeah.
So I do think that there was lessons learned on BP expansion. There was lessons learned on the speed at which vol moved. And I think all that's the way more interesting takeaway to me. The other side to it is when you get that kind of explosion in volatility, you can see what that means for the expected move. And now you've got this, a week later, you have a 200-point up move in the S&Ps. Like, a lot of the math pieces to me came around and make total sense. I think that's a better takeaway, at least for me.
The Volpocalypse blow up of February 2018. It feels like the markets had a similar type of response this time around as well, when volatility implodes higher. Do you find any lessons to be drawn from what happened back then? Either of you, any lessons to be drawn from what happened back then to what happened last week? It's not exactly a 1-for-1 because it wasn't a structured product that blew up.
Yeah. Now you're talking about, what year are you talking about?
February 2018. The Volpocalypse.
Yeah. There was a lot of similarity because 2017, we never had a 1% move. I want to say the whole year in the market. So volatility peaked after the election in 2016. And I think all the way through like November, and then it kind of died down December. And then all of 2017 was absolutely the dead year. I can't remember exactly, but I want to say, I don't think we had a 1% move in the S&Ps the whole year.
Sure, it was 1%. That seems so low.
I know it's.
I remember it was really a small muted move, but I remember it was.
I don't even think we had a 1% move the entire year, and then all of a sudden we blow up in the end of the year. I think it was in January, and then February you had Volmageddon. So I think that's the similarity, Chris, to where we are today. That is the similarity. Is that no volatility for a whole year, and then all of a sudden it blows up. We had no volatility for the first 6 months of this year, and then it blows up.
I think for me, again, it's a nice little test of complacency. I mean, I can't tell you the amount of emails I was getting about people, ramping up in low implied volatility because the strategies had worked time after time after time. And I think a lot of those people paid a little bit of a price if they couldn't hold on to the positions that they had or adjust properly. So for me, it was really just a retest of don't get too big for your britches. Keep everything in line with your number of contracts in each position. Try to stay a little bit diversified with strategy. I think people got heavy into one strategy, short puts, broken wing butterflies, naked puts, that kind of thing. I think it was a good little reminder of what could happen.
Every time we have big pops in vol, 2015, 2018, 2020, 2022, and now, there's always like a little bit of a different reason because the market changes all the time. But the takeaways are always going to be the same, which is, damn, I wish I was smaller. Damn, I wish I was more diversified. Sure. And I don't think you can ever actually like you never can see it coming. That's why it happens. That's the whole reason it happens, because you cannot see anything coming.